Most people enter the stock market wanting to make their money grow. But the way you approach the market can completely change your experience and results. Some people sit glued to charts, buying and selling constantly. Others quietly buy good companies and hold them for years. Both groups talk about investing, but they're doing two very different things. Knowing the difference between trading and investing is not just about terminology. It's about understanding your own goals, your patience level, and your risk appetite. Let's break it down in detail. The core difference: trading and investing both involve buying financial assets, but the intention behind each is very different. Trading is about exploiting short-term price movements to generate quick profits. Traders might hold a stock for a few seconds, hours, or a few days, aiming to benefit from even small changes in price. Investing, on the other hand, is about building wealth over time by holding on to assets for years or even decades. Investors focus on the underlying value of a company, believing that if the business grows and succeeds, so will their investment. While both approaches involve risk, they cater to entirely different mindsets. One is fast-paced and tactical, the other slow and strategic. Time horizon time is perhaps the clearest way to distinguish between trading and investing. Traders operate on very short time frames. Day traders close all their positions before the market closes each day. Swing traders hold for a few days or weeks, and momentum traders might enter and exit within minutes. Investors, however, think in years and often decades. They understand that markets will fluctuate in the short term, but believe that quality assets, like strong companies or index funds, grow in value over time. This difference in time horizon means that traders constantly monitor charts and react to market news, while investors can often set their strategy and check in periodically. Strategies and tools. Traders rely heavily on technical analysis to make decisions. They study price charts, patterns, and use indicators such as moving averages, the Relative Strength Index, RSI, and volume trends. Their focus is primarily on market behavior and timing. Investors, by contrast, use fundamental analysis. They look at a company's earnings, revenue, debt, competitive advantages, and leadership quality. Investors focus on whether the business itself is worth owning, not just what the stock's price is doing. This fundamental difference in strategy reflects their different goals. Traders seek short-term gains. Investors seek long-term value. Risk profile risk is inherent in both approaches, but it manifests differently. Trading can be much riskier on a short-term basis because prices can move sharply within hours, and traders often use leverage to magnify gains, which also magnifies losses. A bad trade can wipe out a significant portion of a trader's capital. Investors, by contrast, face the risk of long-term underperformance if they choose weak companies or panic during downturns. However, by holding a diversified portfolio and letting investments compound, investors can often ride out short-term volatility. The crucial point is that traders accept higher immediate risk in pursuit of quick rewards, while investors rely on time to mitigate risk. Costs and taxes. The cost of buying and selling also differs greatly between traders and investors. Traders execute frequent transactions, incurring higher brokerage fees, spreads, and sometimes even subscription costs for trading platforms and real-time data. These costs can eat into profits, especially for beginners. Furthermore, many jurisdictions tax short-term trading gains at higher rates than long-term investment gains, meaning that traders give up a larger portion of their profits to taxes. Investors typically buy and hold, which means fewer transactions, lower overall costs, and often more favorable long-term capital gains tax treatment. This makes investing generally more efficient for building wealth over decades. Emotional challenges. Psychology plays a huge role in financial success. Traders often face intense emotional swings due to rapid market changes. Fear and greed can lead them to exit good trades too early, or hold losing trades too long, chasing quick wins, or trying to make back losses. Investors face a different challenge: patience. They must resist the urge to sell during market downturns and remain confident in their long-term strategy even when prices fall. While traders need discipline to execute strategies without being swayed by emotions, investors need the emotional resilience to stick to their plan through years of market ups and downs. Time commitment. The lifestyle and time commitment required for trading versus investing are dramatically different. Successful traders often spend several hours each day analyzing charts, following news, and watching price movements. It can feel like a full-time job. Investing, by contrast, requires more upfront research, such as choosing the right companies, funds, or strategies, but less ongoing attention. Once a portfolio is built, an investor might only review it a few times a year or when personal goals change. This makes investing more accessible for people with full-time jobs or other commitments who still want to grow wealth steadily. Expected returns. Both trading and investing can be profitable, but their return profiles differ. Traders aim for frequent, smaller gains that add up over time, though losses can be just as frequent. Some traders generate impressive returns in a short period, but many fail to outperform the market after accounting for costs and taxes. Investing tends to produce slower but steadier returns, often boosted by dividends and the power of compound growth. Historically, broad market indexes like the S&P 500 have provided annualized returns of around 7 to 10% over decades, which long-term investors benefit from without the stress of daily market timing. Matching approach to personality. Choosing between trading and investing often comes down to personal temperament. People who enjoy fast-paced decision-making, thrive under pressure, and can devote several hours a day to markets may find trading appealing. Those who prefer a more hands-off approach, value steady progress, and are willing to let time do most of the work will usually do better as investors. Some individuals adopt a hybrid approach, putting most of their money into long-term investments while using a small portion for active trading to balance stability and excitement. Real-world example. Consider a well-known company like Apple. A trader might buy shares ahead of a product launch, hoping for a short-term price bump if the launch goes well, and sell soon after. An investor, however, buys Apple shares because they believe in the company's long-term potential to innovate and grow revenue. Over time, the investor benefits from both rising share prices and dividends. This example shows how the same asset can serve two entirely different purposes depending on the approach. Long-term performance. Decades of market history show that consistent long-term investing in diversified portfolios often outperforms frequent trading. Even many professional traders struggle to beat simple index funds over time. While trading can occasionally deliver large short-term wins, it's often accompanied by equally large losses. Long-term investors, especially those who reinvest dividends and remain patient during downturns, tend to build substantial wealth. Understanding this historical pattern is crucial for setting realistic expectations about which approach might work best for your financial goals. Trading and investing aren't just two techniques, they represent two very different philosophies about money and time. Traders focus on short-term price movements, aiming to capitalize on volatility, but must accept higher risk, higher costs, and greater emotional strain. Investors focus on long-term growth, aiming to let compounding work in their favor, but must be patient and committed to their strategy. There is no universally right choice. The best approach is the one that aligns with your personality, schedule, and financial objectives. Understanding these differences is the first step to making smarter decisions and building a strategy that you can stick with.